Good afternoon, and welcome to Johnson Lambert's 2020 Nonprofit Accounting and Financial Reporting Update. I'm Kristen Hogan, Senior Manager with Johnson Lambert. First and foremost, we hope you, your families, and your loved ones are staying safe and healthy. These are challenging and unprecedented times, and we are so very grateful you took the time to join us today. In the midst of everything else going on, we are now tasked with trying to wrap our heads around the accounting implications affecting the nonprofit world. Therefore, for the next hour or so, we are going to share with you some nonprofit accounting and financial reporting updates with a focus on the items that we feel are the most impactful to our clients and friends of the firm. Before we kick off today's presentation, I would like to cover a few administrative items with you. You can download a copy of today's presentation from the Orange Resources Circle. If you experience any technical difficulties during the webinar, including audio or video problems, press F5 to refresh. View the webinar using a different browser or press the Help button. To engage with our presenters today, please submit your questions in the gold Q&A circle. We will do our best to answer as many of your questions during or at the end of today's session. For those interested in receiving CPE or CAE credit for participating in today's webinar, I would like to call to your attention the certificate icon. You can launch the certificate window to monitor your progress toward earning your certificate. Once you've met the criteria, you will see a certificate image appear in the certificate window. Click on this image to download your certificate. The only way to obtain your certificate is by downloading it through this platform. Credit is not available for group viewing. You can now also view the webinar on your tablet or mobile device and receive CPE or CAE credit. Johnson Lambert uses polling questions for credit verification purposes. To receive your CPE or CAE credit for today's session, you will need to be present for at least 50 minutes and answer at a minimum 3 of the polling questions. We also encourage you to complete a brief survey at the end of the session, as your feedback on today's course and thoughts on future webinars are valuable to us. Without further ado, please join me in welcoming today's speakers. Joining me today, we have assembled an excellent duo, our nonprofit audit experts, Andrea Wright and Sarah McConnell.
Hey, Kristen.
Hi, Kristen. Hi. Before we get started, let's review the agenda for today's presentation. Today, we are going to review accounting impacts of COVID-19, details about Paycheck Protection Loans, going concern, as well as upcoming accounting standards. Now it is time for our first polling question. The question is, would you like to receive CAE credit for today's presentation? Yes, no, or NA or JL employee. Make sure you push the submit button after you select your answer. As a reminder, answers submitted to the Q&A section do not count towards CPE or CAE credit. We will leave you with another couple of seconds to answer the polling question. I will close the poll. Now I'm going to turn it over to Sarah, who's going to get us started today.
Great. Thank you, Kristen. Today, we just wanted to set the tone with some of the impacts as a result of COVID-19. And I know all of you are dealing with your own challenges, whether they be operationally and figuring out how to maintain a remote workforce, or financially driven because you've had to cancel meetings or make changes in your membership structure. All of those impacts definitely have an impact. All of those situations have an impact on the accounting and the finance function at an organization. You may also be in a situation where you've got members who are struggling or employees and different vendors who've had to change their ways of operating their business. And what we want to just remind everyone today is that those operational changes have an impact in your financial situation, and you can definitely expect both operational and financial impacts to be a focus of the audits coming up, and should be a focus of board discussions and management's review of 2020 performance and outlook into 2021. We just want to remind everyone to have that mindset about the uncertain environment that we're currently living in and the risks that that creates as we talk about the changes that are upcoming. Let's dive into some of those details. And one of the biggest changes that happened in 2020 was the Small Business Administration issuing the Paycheck Protection Program loans. Many nonprofits have taken advantage of these loans. They were very much designed for small businesses to be able to continue their operations and to be able to maintain their payroll without disrupting their business operations or dipping into their reserves. So we're going to look at how to account for these loans because, as with any new federal program, it's not always straightforward. Before we get started, let's do another polling question. Did your organization take a PPP loan, and are you planning to apply for forgiveness? Yes, we took a loan and plan to apply for forgiveness. Yes, we took a loan but do not plan to apply for forgiveness. Yes, but we've returned all of the funds. Or no, we did not take a loan. If you would please select your answer and then press submit, it will just help us be able to better cater today's presentation. And remember, you must press submit to get CAE or CPE credit. I'll give everyone just a few more seconds to get their answers in. Okay, let's look at the results of this question. As expected, most organizations either did not take the loan or they did take the loan and they plan to apply for forgiveness. Most of our clients and friends of the firm that we're talking to who did take the loan are intending to apply for forgiveness because it is, such a great benefit that was offered by the SBA. Even those of you that did not take a loan, I think you'll still find this next section rather interesting. The accounting behind the PPP loan is kind of fun for those of us in the finance and accounting world, just to think about how to account for a loan that ultimately is going to be forgiven. So guidance has come out that has allowed 4 different models to be used for accounting for the PPP loans. Each borrower needs to review their own set of circumstances to determine which is the appropriate method, but I will tell you that nonprofit organizations really only have 2 of these 4 models available to them. The first one is under FASB ASC 470, which is the codification section that addresses debt, which means you would be accounting for this as a loan, as a liability in your financial statements. The other section is FASB ASC 958-605, which is nonprofit entities revenue recognition, specifically the contribution standards for nonprofits. So if your organization has a contribution revenue stream, you're very familiar with this standard, which takes you through the definitions of with and without restrictions and conditions and unconditional contributions. This is typically reserved for nonprofit organizations, but for-profit organizations are able to use this model under the guidance that has come out from the FASB and the AICPA. We're going to focus on these 2 models today. As I mentioned, the other 2 are not available to nonprofits, and we'll look at these in a little bit more detail. First up is that first option, accounting for the PPP loan as debt. If you choose this method, you're following the legal form of the PPP loan issuance. Basically, you're saying, we got a loan from the SBA and we're going to record this debt as a liability within the statement of financial position. You would remove that liability when the legal release from the primary obligor occurs. Meaning when the SBA notifies you that they have released you of the loan, they've forgiven the loan, you would take the liability off your books and you would recognize a gain in your statement of activities for the amount of debt that was extinguished as a result of the forgiveness. That amount can include accrued interest that may exist, but the important thing to remember here is you keep the liability on the books until the legal release occurs, and that's going to be from the SBA, not from the bank. The forgiveness process for these PPP loans includes 2 steps. The first one is through the bank that you originally applied for the loan for, and then the second one is through the SBA. And each of these organizations has a set period of time to respond to you. But it's important to remember it's that primary obligor that's going to trigger recognizing this as a gain in the statement of activities. There's also going to be a reporting element of this in the statement of cash flows. Any amounts borrowed under the PPP loan will be shown as a cash inflow in financing activities, and any payments that you may make would be a cash outflow of financing activities. If that loan gets forgiven, you would show that as a non-cash financing activity, which is generally shown below the total cash in the statement of cash flows, or could be as a disclosure in the notes to the financial statements. And if you have interest forgiven as part of the loan, then that becomes a reconciling item between net income and your cash from operations. If you choose this model, you want to make sure you're considering any debt covenants that you may have from other existing loan arrangements and the impact that this could have on those debt covenants. And then you also want to make sure that you're following the other related disclosures in your financial statements for ASC 470 debt disclosures, which includes details about the loan, the terms of the loan, as well as more information on the plans for forgiveness and the ultimate resolution of that agreement. The second option, accounting for the loan as a contribution, is a little more complicated, and this option is going to follow accounting for this as a contribution or a government grant. And in substance, what you're saying is if you choose this model, you really are thinking of it like a government grant, where someone has given you money for a specific purpose, and when you use that money, you will ultimately recognize that income. If you choose this model, it will be reported as a conditional contribution within the financial statements, meaning that the conditions need to be substantially met as of this balance sheet date without any ability to forecast the probability that they won't be met. And so you need to be recording that as a refundable advance, as a liability, until those conditions get met. And then at that time, you can record the income into the statement of activities. The conditions that exist in this arrangement relate to the original terms of the agreement. For those of you that may not be familiar with the PPP loan, it was given with certain stipulations if you were to apply for forgiveness that you would be using the money for qualified expenses that were related to payroll or leasing arrangements or mortgage payments. Certain payroll related benefits were included in that as well. You also had to agree to not reduce compensation for employees and to maintain a full-time equivalent headcount as well. And so those are some of the very quantifiable variables that exist as part of the conditions. There's ultimately also a question about eligibility being a condition as well. And was the organization originally eligible to receive that loan based on the original program design? There is another school of thought to think that the actual submission of the loan forgiveness, the document that takes place, could be considered a barrier. Some organizations have come out to say that they believe that to be an administrative matter, meaning it's just the paperwork at the end of the process, and they think it's self-evident that they will be eligible for that forgiveness, and so they don't consider the loan forgiveness documents to be a barrier, but that's certainly a position that management would need to make a judgment about as to whether or not the forgiveness documents existed as a barrier as well. If you choose this method of accounting, the statement of cash flow presentation is a little bit different than the loan method. In this method, you're going to show the loan proceeds that are expected to be forgiven as operating activities, and anything that you do not expect to be forgiven would show up as a financing activity like the debt model. You're going to also follow the required disclosures for contributions that are outlined in ASC 958-605, outlining the policies that you have for accounting for contributions and any of the conditions that exist and the amounts that are recorded under this model. It is entirely possible that you have partial derecognition of this liability. So especially for organizations that don't have a 12/31 year end, or at 12/31 might be in the covered period of their loan. That covered period is either 8 or 24 weeks. For loans that were issued after June 5th of 2020, your covered period is 24 weeks, meaning that's the amount of time the SBA is allowing you to spend that money for the qualified expenses and meet the definitions to allow for the terms of forgiveness. For those of you that got a loan before June 5th, You could elect 24 weeks or 8 weeks. 8 weeks was the original term that they set out, and then decided to allow organizations more time to spend the money and have the forgiveness option. But you could see that if an organization has a fiscal year end or is partially through their covered period, they might be in a position where, as of their financial statement date, they're going to want to partially derecognize the liability. They may be saying, we have met the conditions up through this date and we've satisfied those barriers, and we want to recognize the portion of this loan into income that we believe will be forgiven. Accounting for that as that conditional contribution definitely requires judgment, and to be able to make that decision about the partial derecognition of the liability is something that we're going to spend a little time looking at in more detail. The question around this and recognizing any amounts into income, whether it be the partial amount or the full amount, really lies in whether or not you think the barriers have been met and those conditions have been satisfied. So just to review what we talked about a couple slides back, we really think there's 4 main areas of barriers related to this program. The first one is the eligibility for the program. The program was designed for specific types of organizations that were smaller than 500 people, that met certain thresholds with regards to type of nonprofit classification. And we want to make sure that if we are going down the route of recognizing this into income because we think it's going to be forgiven, that's really the first step. We'll make sure you were eligible in the first place. And I know that kind of sounds obvious, but we've certainly seen some questions arise around this. And I'm sure you all remember earlier in the spring and early summer, a lot of large organizations were taking these loans. And I think I just saw a headline this week as well about the percentage of the dollar amount of loans that went to organizations that are considered public companies or Fortune 500 companies was rather staggering. So that is this first question: are you eligible for the program and for the loan? And if you are, and you've satisfied that barrier. The second element is the eligible cost. Those qualified expenses under the program are important to make sure that you are spending the loan proceeds according to the way the program was designed. The SBA has very specific rules, and I won't be able to cover all of them today. I encourage you to review the frequently asked questions on their website because they've done a great job of clarifying all the different kind of types of expenses they were allowing in terms of the benefits that can be included or are excluded, the salaries, how to calculate the mortgage element of it, and what time period utilities are available. So I would definitely encourage you to make sure when you're looking at the qualified expenses, you're comparing it to those original definitions and the guidance that was put out by the SBA. There's also, the SBA has also put out specific requirements to maintain or quickly rehire employees, or if you do you do terminate an employee or an employee doesn't come back, have you made an offer? Have you tried to hire that person back? Have you made a good faith effort to rehire those employees? And those, again, those terms of what that looks like and what the rules are detailed out on the SBA's website. You also had to maintain certain salary levels, and the SBA has provided thresholds and rules for if those salary levels were not maintained. What does that mean to the amount of the loan you can have forgiven? And so you'll want to make sure you look at that. If for some reason you are not able to maintain those salary levels, it can impact the forgiveness process. And then, like we talked about, the application for forgiveness approval, management might determine that's administrative, and you would want to document that conclusion. That really is, a possible barrier that exists, and some people will say that it's kind of tied back to the eligibility. If there's any question about the eligibility for the program, then the application for forgiveness is likely not just an administrative matter. So I wanted to walk through this with you because I think in order to truly understand this, it's a lot of words, and the accounting can get complicated, and the program can be rather complicated. I think it's helpful to just kind of take a step back and say, okay, what does this actually mean? Let me walk through an example with you, and we can look at any questions that may come up. But here's an example, some background facts of a nonprofit organization. They have a June 30th year end. They requested and received a $1 million loan, and that loan was actually received 5 weeks before their June 30th year end, so in the month of May. They elected an 8-week cover period. So they were saying that we are going to spend that $1 million in 8 weeks, and we're going to plan to apply for forgiveness after June 30th when our covered period expires. There's no questions about this organization's eligibility. They have less than 500 employees. They've documented their position using considerations from legal counsel as well as from management and the board as to why they think they're eligible. And as of June 30th, they had $700,000 in qualified expenses. This included salaries, which were adjusted for the $100,000 cap limit that the SBA had identified. They also have mortgage payments that they've included in here and some other benefits. But one interesting thing is that this organization has documented that they are not going to meet the headcount requirement after June 30th. They've had terminations and changes in their employee counts that are going to cause them to not meet that headcount. So this is what the calculation would look like. We're trying to figure out what amount do we record as income as of June 30th, and what amount do we record as that refundable advance liability? Because in this example, the covered period spans the fiscal year end. So we know we're going to have some portion of this that's going to be recorded as income. We're going to want to partially recognize that, and the remainder is going to be as a refundable advance. So as of June 30th, we were 5 weeks into the 8-week cover period, so 3 weeks remaining after June 30th. If you divide that 3 weeks by the 8-week cover period, that means 37.5% of the covered period is taking place after year end. 62.5% was used up as of June 30th. So we had $700,000 in qualified expenses. If we multiply those percentages by the 700,000, so 37.5% times 700,000 is 262,500. Those are expenses that I've already incurred at June 30th, but the barriers and the conditions are not substantially met because I'm only partially through my covered period. 62.5% of the $700,000, 437,500, are going to be allowed for forgiveness because that's the percentage of the covered period that I have already completed and had qualified expenses for. So in this example, the $700,000 in qualified expenses is going to be reduced to $437,500 that I can record as income at June 30th, 2020. I think this is really important because I know a lot of people, when they understood the program initially, they thought, well, if I incur this much of expenses by my financial statement date, then that would just be the amount that I record. So they would just say, well, I can obviously record $700,000. I'm going to have $700,000 in expenses. But the calculation, when you go through and actually do the application for forgiveness, what you're saying is, I'm going to go through and do that application as of June 30th, because that's really, in theory, what you're saying is that you would like to apply for forgiveness for any amounts that are available at June 30th. And when you do the application, it would make you reduce your amount of qualified expenses by the percentage of covered period that you're into the program at. So that's why there's this difference between you've incurred $700,000 of expenses, but I can only recognize income of 62.5% of that because I'm only partially through my covered period. So if after June 30th, they've maintained their headcount and they've maintained everything, there's certainly the potential that that remaining amount, the $262,500, would be recorded into income, but that would be after June 30th. Now, you remember in this situation, we had a little more complexity to it where they admitted that they did not maintain their headcount. So it's also possible that if that headcount wasn't maintained exactly on, starting on July 1st, that remaining amount that wasn't taken into income now just becomes a refundable advance or would get converted to a loan once they knew that they weren't going to be able to apply for forgiveness. So in this situation at June 30th, we had $1 million loan. $437,500 is going to be recorded as income. The remainder, $562,500, is going to be recorded as a refundable advance. And that's our financial position at June 30th. What happens after that, then we determine what amounts remaining of that 562 were eligible for forgiveness based on us meeting the criteria, and what elements ultimately were not eligible if they ended up not maintaining their headcount or somehow not maintaining the criteria. So I hope this example is helpful just to kind of take a step back and really think about it. One of the best tools I've seen is the AICPA, which is the American Institute for Certified Public Accountants, has a PPP loan help page on their website. And they made portions of it available to non-members. But one of the documents they have is a PPP loan calculator. And it's an Excel spreadsheet that just walks you step by step through the application for forgiveness. It very much details out all of the types of qualified expenses and helps guide you through the process of what you would input into your application for forgiveness. I would encourage anybody that plans to apply for forgiveness to download this calculator. We're not sponsored by them. We don't have any relationship. I just think it's a really great tool. And when you download the calculator, if you put the same set of circumstances in, it would give you that same answer. But it has all the details in there about what the SBA has said is qualified. It takes you through how to prorate for the covered period. It's a great tool that I think would be helpful to you, especially for those of you that will be partially through your covered period at your fiscal year end.
Okay, thank you, Sarah, for that information. It's time for our next polling question. Our organization plans to account for our PPP loan as follows: debt, ASC 470, conditional contributions, government grant, ASC 958-605, still undecided, NA or JL employee. And I'm going to give you a couple of extra seconds to hit submit, and then I will be closing the poll. Okay, and it looks like there's quite a variety of answers. It looks like a portion of you plan on accounting for the PPP loan as debt. About a third of you plan on accounting for it as conditional contributions, and about a third are still undecided. Sarah, can you please provide us with some other things to consider before determining the best accounting treatment?
Yes, absolutely. I do think it's important as you're looking at making that accounting decision to consider all the factors and what you're familiar with as an organization. The accounting method as ASC 470 is considered a safe harbor method. It's a very conservative model to just record it as debt. Ultimately, you will, if your application for forgiveness is approved, ultimately you will be able to carry that into income. It just may be a timing difference between when you incur those qualified expenses and when the income is recognized. But I think it's easy to explain that to your board members and members in your financial statements as well. As we walked through, the application for forgiveness and the calculation of that amount is a little more complicated when you're doing it from a financial reporting perspective for a conditional contribution. But I know a lot of the nonprofits are already familiar with the concept of accounting for conditional contributions. This one just has a little extra intricacies in it that I think are still able to be worked through by your organization. I would just encourage you to look at the guidance hand in hand as you're making those calculations and decisions. There are some other things to consider as well, though, as you're making these decisions, particularly for loans that are greater than $2 million. The SBA has come out and provided a safe harbor for loans under $2 million, but has said that they expect to do some sort of review or audit for loans that are over $2 million. And in determining that $2 million threshold, if you had any affiliates that took out loans, you would be aggregating those together. There's still some question about what this review or additional procedures by the SBA looks like. And in fact, in October, the SBA issued some additional loan necessity questionnaires that they required those who had a loan greater than $2 million to complete. For nonprofit borrowers, that was SBA Form 3510. That form went into detail about the financial position of the organization, asked more questions about what their financial position was in February of 2020 compared to February of 2019, what changes in their operations were incurred during 2020, and what was their liquidity assessment? What other access to capital did they have? Did they have any endowments either with them or at related organizations? It was rather a very detailed form that very much is getting at the need of an organization to take the loan. And so I think that's something to keep in mind, is that the eligibility for those who took loans greater than $2 million is certainly an area of focus for the SBA. And I think it's important to remember as well that this program was rushed out rather quickly, very much because it was a necessity for organizations when the economy was shut down. But I think that some of the details are still being worked out, and I expect we might see even more questions from the SBA for these types of loans where you're needing to provide even additional information. For those of you that had loans under $50,000, they do have a simplified application for forgiveness, and you are exempted from reductions in forgiveness based on either changes to your full-time equivalent employees or those salaries. So what we talked about is those barriers do provide an exemption if you have a loan under this threshold. But in that application for forgiveness, you are making certain certifications and needing to provide documentation for the cost that you incurred as part of that loan, specifically the cost that you're asking to be forgiven. No matter what method you choose, the important part is that you have support for the loan itself and for your position in the accounting for the loan. Make sure that you have documentation, either legal support or other type of support from management for the basis for certifying the need for the loan. When you applied for that loan, someone signed a certification stating there was a need, and you want to make sure that you've supported that need, as we've seen that eligibility is clearly a focus of this loan program. We also want to make sure when you are requesting forgiveness that any qualifying expenses are appropriately supported. Even if they're not asked for in the initial loan for forgiveness, you want to keep that audit trail available so that someone is able to come back and look at that supporting documentation as part of the forgiveness process. And then make sure you have your accounting policies updated related to the loan. If you're an organization that has never really followed the contribution method of accounting, you want to make sure you've got accounting policies that state what your policy is and how it relates and follows the generally accepted accounting principles. And same thing, if you're an organization that's never had debt before, you want to make sure your accounting policies are updated. Some good news is that the PPP loans are not going to be subject to single audit requirements. So those of you that are familiar with those additional stringent audit procedures, you have some relief, and that they have come out to say these SBA PPP loans will not be subject to those additional requirements. But there are other types of CARES Act loans, such as the economic injury disaster loans and other COVID-related program loans from other government agencies that will be subject to single audit requirements. So this exemption was purely related to the SBA PPP loan program. I did mention this AICPA resources tool already. I think it's a great resource for you. It's got the calculator is very user-friendly in that it's an Excel workbook that kind of takes you through all the details. They also have free access to all of the guidance and links to the SBA website. Their SBA website itself is very detailed. I like the frequently asked questions, and it seems to be updated at least every month or every couple of months with additional information and guidance that's come out. And then the last thing to touch on here is the tax considerations. I know nonprofits are tax-exempt organizations, but there are some tax-related considerations for these loans. These loans are going to be treated as debt for federal income tax purposes, and the interest expense associated with that debt would be deductible. Meaning, the IRS has come out and said that you can if you plan to apply for forgiveness of those loans, that forgiveness, that income is not going to be considered taxable income. But the expenses that you use to support the loan forgiveness, those payroll costs or rent or utilities, cannot be used as a deduction against other taxable income. So if you have unrelated business income streams, you need to consider the tax deductibility impact of those costs that you might normally allocate to those UBI streams. If they were used as part of the qualified expenses and forgiveness, you can't also use them to be deductions for your UBI. So that is an important element to keep in mind. There could be timing issues between expenses occurring in one year and the income being recognized in another year as well. The IRS has put out recent guidance and we expect going to continue to put out guidance around this because there is some question about the tax guidance that came out in the original program and from the original rules that Congress approved versus the IRS guidance. And so I do expect in the next couple of months to continue to see additional guidance. Perhaps this could change, but this stance is what the IRS has put out as of now. So I would just stay tuned for any potential tax impact for nonprofit organizations as well. And with that, I will turn it over to Andrea.
Thanks so much, Sarah. For that PPP update. I think that is at least what all my clients are talking about, most of them, and so that was really helpful. We wanted to take this time to talk with you about going concern. Going concern is not new. Going concern standard isn't new, but we wanted to remind you of the going concern standards requirements and the documentation requirements. Just given the time that we're in, we've seen this past year a number of organizations for the first time have to document going concern considerations beyond what they've had to document and think about in past years. We suspect that this year will be the same as you're preparing your 2020 financial statements. We suspect that many organizations will be documenting going concern considerations in a way that they have not before. And even into 2021, as some organizations that I've spoken to have said, you know, we survived 2020, we think we're stable. Our big concern, you know, now is our next year. So going concern is a timely topic to just revisit. As a reminder, going concern is in the accounting guidance. Prior to 2016, going concern and going concern considerations was housed in the auditing guidance, which meant it was an auditor's thing, and auditors needed to take steps and do things. Well, in 2016, FASB came out with ASU 2014-15 that said, wait a minute, going concern really is a management responsibility and a management tool, and it really should be housed in the accounting guidance. So remember, the accounting guidance are the standards that management uses to prepare financial statements, and then the auditing standards are the standards that auditors use to do audits. So what did ASU 2014-15 do? I like to talk about it or think about it kind of in a three-word thought. The accounting guidance for going concern helps management determine whether there are issues of going concern, when a going concern issue is raised, and then how to disclose those going concern issues if they are raised. So the goal with issuing this accounting standard is really to reduce the diversity in practice and the timing and content of footnote disclosures. Because going concern, there's some judgment or has been some judgment on when going concern issues really were raised, and if raised, how they should be disclosed. And, you know, you had a really a diverse set. You can, you know, pick up a financial statements of multiple organizations that were similar and had similar situations and have a range of different disclosures for the same situation. So this standard really puts some framework and some direction around going concern that makes documenting and disclosing going concern considerations consistent organization to organization. I might be biased, but I think the standard does a really good job of being a plain English standard. So it's a standard that I think just about anybody can pick up and follow and get to the right answer. So the main provisions of the standard include helping an organization, helping management understand when substantial doubt exists. So right in the standard spells out pretty plainly, it doesn't make you guess, that if there are conditions and events considered in the aggregate, you think about all the conditions and events, if you consider everything in the aggregate, and there is an indication that it is probable that an entity will not be able to meet its obligations when they become due within 1 year of the financial statement date, or when the financial statements are issued or available to be issued. Generally, that's measured by the opinion date, so not the balance sheet date, but the opinion date. Then substantial doubt exists. So it's a pretty clear definition. Management is probably making this assessment generally anyway. You're probably doing a budget. You're thinking about, usually less than a year, thinking about your next quarter or your next half year, how we're going to meet the obligations within that time frame. So this standard really just kind of puts it in a formality. So one of the things that I just want to highlight here that this accounting standard does that's different than the auditing standard is that the date of consideration, or the date that you need to be looking to, is 1 year after your financial statements are available to be issued. That's a longer period than the auditing standard prior to this accounting standard. So just think about 1 year from the date your financial statements will be issued is well into sometimes the next fiscal year. So in that way, going concern considerations is a look forward, right? So your look forward period is a lot longer than it had been, which means you need to take into consideration, management, subsequent events. So you not only need to be thinking about, yes, I made it through the current fiscal year, but you have to look 1 year beyond that just about, because this standard requires that you look to one period beyond the date of your audit opinion. So while your auditors are out during 2020 audits, if your audit opinion is going to be dated in March 2021 or April 2021, the going concern consideration period that you need to be looking at is March 2022. So that's how, even if you found that your 2020 ended up just fine, you still may have the need to make some disclosures in your 2020 financial statements because your look-forward date is 1 year out. So that's why we thought this topic was really timely. So when you're doing your consideration this year on going concern, what I would encourage you to do is to formalize that process and maybe write a memo or write it down, not just for the auditors, but really for your own internal use and for the board's use. And we're going to walk through some considerations as you're kind of putting together maybe a memo for your file. But the thing to remember is that you need to consider any relevant or conditions, and this is right in the standard, that are known or reasonably knowable. So anything that you know about today that has, subsequently happened since you closed your year end, or anything that is reasonably known. So that means you may have to get out of finance and understand what's going on in the organization. But if it's reasonable that you should have known it, then you need to consider that when you're thinking about going concern considerations. So the standard gives a very nifty flowchart, which I find very helpful. So if you're like me and you're a visual learner, this is absorbable. So the standard breaks it down, and at the end of the day, it's really just 2 steps. One, evaluating whether conditions and events exist, either yes or no. If yes, you need to assess if substantial doubt exists. And it gives you some definitions around it, but at the end of the day, the standard is requiring you to just do a two-step process. And so we're going to walk through this process at a high level just to give you an idea of what we believe some documentation might look like that would satisfy the requirements of this standard. But before we do that, I just want to share with you some conditions and events that are applicable or tend to be most applicable to nonprofit organizations. The AICPA has done, I think, a great job in the not-for-profit section in the audit guide of tailoring some common conditions and events that affect nonprofits that in our language, right? So if there's been recurring operating losses, or said another way, recurring losses from unrestricted. So you don't have, a lot of revenue to cover your G&A costs, your operating costs. Credit concerns about upcoming debt maturities if you have debt. Legal proceedings. Are there legal proceedings which could cause the organization an event to happen that you need to assess? Are there legal proceedings maybe not at your local organization, but at a parent company or at an affiliate organization? One that we saw a lot this year, loss of key revenue streams. So Sarah mentioned earlier on, a lot of organizations cancel their meeting, their annual meeting, and maybe their annual meeting was their largest revenue driver. Or if you're a C3, you had a gala or some fundraising event, and that had to be canceled in 2020. So if you've lost a key revenue stream, you have a condition and an event that has occurred in which you should be going to this standard and documenting considerations for going concern. Significant expenses. Also what is really kind of unique to this time period, thinking about the organization's ability to continue operating in a remote environment. Now, most organizations transition to a remote environment just fine. Some organizations had a bit more of a hurdle. Is your organization positioned and able to continue to operate in a remote environment for an extended period of time, or is operating in a remote environment hindering your organization from processes and things that you need to do? Okay, so step one is continuing to evaluate conditions and events. Just keep in mind future conditions and events can create substantial doubt. We talked about this because the look-forward period is 1 year from the date that your financial statements are available to be issued. So your cutoff period is not when the auditors sign or leave. It's 1 year from that. So there could be things that are coming up after your year end that really affect the disclosures for 2020. So again, thinking about some of these things, if you're an organization that has debts that are maturing or that will become due after your year end, you'll have to take that into consideration. Again, I think a common one that we might see again this year is loss of key revenue. Again, where organizations will not be holding their major events. Even if your event looks different, if you've gone from an in-person event to an online event, I think that's still a condition that is probably deserving of some analysis and evaluation. May not be likely that your revenue is going to be at the same level if you're hosting an online fundraiser versus an in-person fundraiser, or an online annual meeting versus an in-person annual meeting. One suggestion that I would offer up is to list out each condition separately. So I think you might find it easier to list out everything that you can think of. Not everything is going to raise to a level that you need to do further analysis, but I think it helps provide a pathway so that you don't forget anything. And then you also comply with in the aggregate. So, a single condition alone may not cause going concern issues. But if you have 4, 5, 6 conditions, you really do need to think about if those conditions in the aggregate are raising issues with going concern. So say you write down, or you have no conditions. You take a look at your operations. You say, yep, nope, we don't have any conditions. Nothing comes up. I looked at the list. I really just don't think there are anything. Then you stop. So there's nothing else you need to do if no conditions or events are identified. You give a memo maybe to your auditors who would love it to just say, I thought about this, there are no conditions. It gets a little bit interesting when there are conditions identified. So when there are conditions that, when considered in the aggregate, raise doubt, you have to think about what mitigating effects could be considered when you're saying there are mitigations in place. The standard offers this definition of probable. So management would have to have a plan to alleviate any substantial doubt, but you have to think about if that plan, is it probable that the plan could be effectively implemented within that 1-year period, look for it, and if it's probable that your plan will mitigate those conditions. So keeping that in mind, that's kind of an analysis that you need to work through, which is not necessarily always cut and dry, but it's one that you need to consider when you're thinking about if conditions are raised. Now, once conditions are raised, you're in a disclosure situation. So you will have to have some level of disclosure in the footnotes once a condition or event is raised. The extent to those disclosures will vary depending on if substantial doubt is alleviated or if it's not. So if substantial doubt is raised and is alleviated, meaning your plan that you have will be probable to be implemented and probable that it will alleviate the substantial doubt, you do have to make a disclosure of discussing what the principal events or conditions are that initially gave rise to substantial doubt, what your evaluation of the significance of those events are, and then what your plan is to alleviate those that substantial doubt. So that's when substantial doubt is raised and alleviated. Now, if substantial doubt is raised and not alleviated, you have to make the same disclosures, the first 3 same disclosures that you did if doubt was alleviated, but then you have to add on some disclosures. So there is a requirement when substantial doubt is not alleviated to use the specific going concern language. So you would have to say in your footnote that substantial doubt about the organization's ability to continue as a going concern within 1 year of the financial statement date is raised. You actually have to use that sentence in your footnote. So that's the one caveat or the one thing that's added. Likely the auditor will have added some additional paragraph to the opinion when substantial doubt is raised and not alleviated. That may pretty much mirror the footnote in some way. All right, with that, I'm going to turn it over to Kristen for our next polling question.
Thanks, Andrea. Our next polling question is, under ASU 2014-15, management is required to evaluate if there is substantial doubt regarding the entity's ability to meet its obligations for a 1-year period from the audit engagement letter date, the report release or opinion date, the balance sheet date, NA or JL employee. We will leave you with a couple more seconds, and then I'm going to show the results. And the correct answer is B, 1 year from the audit report release or opinion date. Looks like the majority of you got that one correct. Andrea, I know it's a fairly quiet time in regards to upcoming accounting standards other than all of the PPP and COVID implications we've been facing lately, but can you please share some of these with us?
Absolutely. So, as Kristen said, it is a pretty quiet time. We are very happy for that. In the not-for-profit accounting standards world, we do have a reprieve after adopting RevRec, but we did want to share with you some upcoming standards that are coming down the pike in the next year or so. So when the coronavirus pandemic became known and the effects or the likely effects were determined that they were going to be extensive, FASB did give those organizations who had not adopted 606 a 1-year reprieve, so you could delay it for 1 year. So if you took advantage of that delay and didn't adopt Topic 606 last year, you will have to adopt it this year. In addition, for 2020, the reference rate reform standard goes into effect. So if you use LIBOR goes away, and so you'll have to adopt a new benchmark. There's some changes coming up to the fair value standard that really simplifies the fair value disclosure requirements, not that big a deal. Big deal for nonprofits coming up in 2020 is the updating the definition of collection. So if you are an organization that has collections or you're a museum, this is a standard that you need to become familiar with. Next year, more widely affecting nonprofits, ASU 2020-07 for contributed non-financial assets. So these are gifts in kind, contributed assets. There is this new ASU. It's changing the disclosure requirements for those of you with contributed non-financial assets. I will tell you that you could early adopt it. So if you have large gift in kind dollar amounts, you might want to consider adopting this early. But if not, it's not due to be implemented until next year. Then there are some other things on here, including costs incurred in a cloud computing arrangement. That's going to be 2021. Then some disclosure changes for those of you who still have defined benefit plans. And then finally, leases. So leases has been around. We've been talking about it for a number of years. It's been delayed. It's been re-exposed, and it has now been delayed again. So we'll think about leases in another, in 2021 sometime. And with that, I'll turn it over to Sarah for some final thoughts, and maybe she has time to take a question or two.
Thank you, Andrea. We did get some specific questions in our Q&A specifically related to accounting for the PPP loan under the contribution model and different scenarios. I'm not going to take the time to answer them today because they are pretty specific, but I will just give a general reminder to say, I think that the AICPA PPP loan calculator tool will answer a lot of those questions as to how to adjust for salary limits, how to adjust for certain types of utility payments, what types of benefit payments are allowed, if payroll taxes are allowed. All of that is addressed in there, and certainly we'll reach out to you, those of you that asked questions, and we'll follow up with you via email. But I do just want to remind everyone of those resources that are available. And then there was another question that came through just specifically asking for guidance about which method to choose, whether debt or contributions. And ultimately, that's management's decision. I will just leave you with a couple of concluding thoughts about that. The debt model under ASC 470 is the safe harbor. It's a conservative method. You record the liability. You do get to recognize the income when that SBA forgiveness occurs. The judgment goes into the contribution model. You have to make judgments about the barriers. You have to do the calculation about recognizing the amount that gets forgiven. All of that goes away if you do the debt model, and it all goes away once the loan is actually forgiven. So just those are my concluding thoughts about the Paycheck Protection Program. There's no right or wrong answer. Every organization will make the best decision for them. I do think that 2020 has certainly brought many challenges to nonprofits. We've seen so many changes to revenue streams. Many organizations have to pivot from what their usual strategy is and come up with new ways to service their members or new ways to reach donors to get contributions. And we certainly admire all the work that you guys are doing to make those changes and to adjust your working model to be remote or to respond to the reductions in revenue with appropriate reductions in expenses. I know it's been a lot for management to go through, and we're certainly looking at it as your business partners, wanting to offer help. The reprieve, as Andrea mentioned, is you don't have any significant accounting policies to adopt this year unless you have those PPP loans. So we really encourage management to take the time to focus on these operational and financial changes and think about those new risks that exist in your organization and develop those strategies to help mitigate that risk and really think about what the future looks like. I think we're all in unprecedented times where we're not going to go back to what normal is. We're just going to go back to a new normal and a new way of doing business. And we're excited to see what the future holds and look forward to working with you all.
Thank you, Sarah. We have reached the end of our session. We hope you enjoyed the webinar. If you have any questions, feel free to contact us. If you submitted a question we did not respond to, we will respond to you via email within the next week. Also, please visit our website for details and registration information for upcoming nonprofit webinars. Thank you for joining us today. Goodbye.